Good day, everyone. Well, the job market has already flipped hard. The 2-to-1 jobs to unemployed gap from 2022 is gone. We're basically at 1-to-1 now. We know that initial claims spiked to 231,000, which is the highest in 2 months, as hiring plans created to the lowest January level since records started in 2009. And companies are openly embracing the cost cutting while slamming the brakes on new hires. So that combo, the slashing headcount at the margins and refusing to add workers, it used to scream recession, but this time it's mostly AI-driven efficiency taking over rather than collapsing demand. AI is juicing GDP because companies are squeezing way more output out of fewer people thanks to agentic tools and automation. But nevertheless, the jobs report today came in strong with 130,000 jobs, crushing the estimated 55,000, and unemployment even ticked lower to 4.3% under the estimated 4.4. But it means the Fed will be less likely to lower rates sooner than later. And indeed, the CME Fed Watch futures now show the next rate cut in July instead of June. But QE comes in many forms, as we've discussed, so it does not depend on just rate cuts. And as for AI-induced productivity, the U.S. economy delivered one of the most significant upside surprises in recent memory. Real GDP growth in the third quarter of last year beat consensus estimates by 1.5 percentage points, which was the largest positive beat in the past 10 years. What makes this stand out is not just the headline number, but what drove it. Nearly all of the late 2025 acceleration came from productivity gains rather than an increase in labor hours or employment. Output rose sharply while unit labor costs remained contained. Corporate margins expanded faster than inflationary pressures built up. This is the opposite of an overheated economy. It's an economy becoming structurally more efficient. When growth comes from doing more with fewer workers, the effects ripple through financial markets in many ways, such as revenues rise without proportional cost increases. Operating leverage widens, earnings ceilings expand. Valuation multiples do not need to compress to justify higher prices. And this dynamic helps explain why market leadership has rotated away from narrow, long-duration growth stocks towards cyclicals, value, and small caps. These are sectors that historically outperform when genuine economic acceleration takes hold without inflation overheating. Credit markets are telling the same story. A faster nominal GDP growth improves debt dynamics even as absolute debt levels rise. Companies are growing into their balance sheets and default risks remain contained. Credit spreads are tighter than many expected given the macro backdrop. Now, massive capital expenditure by hyperscalers in AI is a major force behind this resilience. In the view of some, current levels of AI-related spending by the largest cloud providers are appropriate and sustainable rather than excessive. And so far, these outlays appear very stimulative to overall business activity, and that creates a virtuous cycle where you have demand for GPUs, servers, networking gear, data center power, and cooling infrastructure, which then feeds back into broader economic output and corporate earnings. And what this means for major averages, well, we've seen an attempted bounce, but it's been so far in weaker volume, so remain liquid and fluid. And into near term, there's a persistent concern that the massive AI capex is not yet translating into proportional revenue or ROI fast enough. And so this ROI uncertainty has investors asking, when does all this spending turn into real economic, well, rather earnings growth? And there's also this circularity fear that some see as circular spending dynamic, where AI companies buy AI tools to sell AI services, raising questions about sustainable demand, and of course the valuation compression. And underscoring these fears, we have to see AI adoption continue to accelerate. The massive AI spending currently underway is a major tailwind, but for the productivity gains to persist and compound, enterprises and governments must deploy these technologies across workflows. So if adoption slows, the supply side efficiency boost could moderate. We also have to avoid bottlenecks. The current pace of AI infrastructure build out is unprecedented, but it is also straining several key constraints, such as power availability, the high-end GPU supply, advanced chip production, cooling and data center construction, and skilled labor for deployment and maintenance. So any significant delay or shortage in these areas could cap the upside. If bottlenecks emerge and persist, the productivity acceleration could decelerate faster than markets currently expect. So the third quarter 2025 GDP beat is powerful evidence of a productivity renaissance, quietly raising the economy's potential growth rate. The environment supports higher equity valuations, tighter credit conditions, and continued rotation towards economically sensitive sectors, all without triggering the classic inflationary spiral that would normally force aggressive monetary tightening. But nevertheless, productivity-led growth keeps inflation in check, supports margin expansion, and raises the sustainable level of earnings growth. When you combine this with controlled inflation and accommodated financial conditions, you get a bullish environment, especially for companies that can leverage AI to improve efficiency. So we've got the data center stocks. We've recommended to members such as IREN, APLD, CIFR. We've got uranium related stocks. Underlying those is the 2X ETF URAA and the 1X URA. But the path forward is never guaranteed. For the bullish case to fully play out, AI adoption must keep accelerating, and these critical bottlenecks must be resolved or circumvented. So if conditions hold, the productivity-led growth story could have considerable runway here. But if they falter, the market's recent bounce may prove more fragile. So the next quarters of AI deployment progress and infrastructure build-out data will be decisive. Gil, how are you seeing everything?
Well, I'm short the rally. So they opened it up this morning, up at the 20-day on the Nasdaq, and the 10-day got close to the 50-day and went short into that rally, and we're rolling back. I often wonder, does anybody actually read the Bureau of Labor Statistics jobs report? I mean, I'm listening to everybody talk about, oh, it was a strong number, but it's entirely due to the annual benchmark revisions, which essentially erased 584,000 jobs created last year down to 181,000. So about 15,000, I think, a month. So it's all fluffed up, but you know, it's government data. I frankly, I think it's comical that anybody with half a brain would cite government data because it's all made up. And probably Trump threatens to fire somebody or everybody if they don't produce the right numbers because he's living in a fantasy world as well. Some of you may have seen the data came out yesterday, consumer debt at an all-time high, another 1.2 trillion higher. You're seeing mortgage defaults and delinquencies rising rapidly, I think to the highest level since 2020. So, you know, again, this idea that there is this strong AI-driven economy, I'm not buying it. It gets the stocks moving, they're tradable, but, you know, the way I see it, you got short entry at the 20-day line on the Nasdaq Composite. Now, the NYC Composite, which represents the rest of the market, so stuff stocks, and, you know, we're seeing like railroads going, truckers, machinery, and all these companies, they've got crappy earnings growth and sales growth, but money is piling into them and it's driving this index higher. You'll also notice that you get the trannies going, same thing, and the money is just piling into that. So is this the harbinger of a bold new bull market based on, you know, 5% earnings growth in railroads and truckers and other slow areas of the market, or is it a defensive rotation? I think we're at a critical crossroads now, and we'll find out. You see the S&P, which is a little more of a blend of non-tech and tech, backing off from prior highs near the 7,000 level. So it's been a good run for the last week. I mean, you know, a couple of names we talked about. I think AMD, a nice undercut and rally. Let me bring my pen up. But you can see last week when it broke hard after earnings, it undercut all these lows in here, and you had an undercut and rally. And it takes you right into the 50-day. That's pretty much textbook. So if you're short the thing and it was a short just under the 50-day line last week. I guess that would have been last Tuesday. You cover it when you get the undercut and rally along the prior lows. You get the rally into the 50-day, and now you can set up short again. And that's pretty much how it's acting, and it strikes me as relatively textbook. One name we talked about last week that was actually breaking out, Taiwan Semi. Nice shakeout at the 20-day line last week, and you push up to new highs at around 380. That's a good move. I mean, that's a great trade. Probably see how far it goes from here, but I don't know. I'd be looking to take some profits if the market weakens. NVIDIA was an undercut and rally coming up to the 50-day line, and now you're sitting here along these highs. I think they come out with earnings at the end of February, so we'll see how all of that plays out. But that's primarily what I'm seeing. I'm not seeing this great bull market that I want to necessarily be a part of outside of trading it, and it's very ripe for trading. So some of these miners, this is one I talked about in the video report. I want to make it clear that my intention with that report is to have not post very often, and basically some of my better offbeat ideas, looking for some big gains. I think last year one of the big ones was DraftKings, which had a huge move off the lows. Let's see if I can pull that chart up and get a sense of what I'm talking about. Of course, not anymore, right? But it had this great move off the lows. I believe that was into the beginning of the year, and it pumped up, had a big move, and then topped. So now I'm looking at Hycroft Mining. The miners look good. That's what I've been playing on the long side. So, sticking with a few strong ones like Nova Gold is one name, and you can see on Monday you had an undercut and rally along this low here, and there it is right there, and boom, boom, boom. This morning they had it up around 1160. I'm not sure what that was about. There's a big spike in the pre-open. I was looking for news. I didn't see anything. So I puked it. I sold it. So, we'll see how that plays out. But the thing is, they're all reporting earnings now. So I'm not going to play earnings roulette. Barrick came out with earnings last, I think, Thursday. And it's a tepid rally. I mean, they posted great numbers, but they just can't get them going from here. So, I'll take what I can get. And just leave it at that. So in the space, but because I think if the market does get into some trouble, you're going to see everything come down. If we just I'll run through some names here. If we look at the big stock Nasdaq names, for example, Alphabet now has broken below the 50-day line, so that may be a short there. Interesting thing about the Mag 7, the Magnificent 7, is that all 7 of them, because of all the money they're spending on AI, are showing negative cash flow, which for them is highly unusual. So they're pouring all this money into AI, and all I have to say is it better pay off, or there's going to be hell to pay sooner or later, maybe sooner. Intel triggering a short at the 10 and the 20. Meta Platform triggering a short near the 200. Microsoft can't get up off its back. A big spender on AI. You got that annoying Copilot thing trying to jump in all the time, which I don't need, frankly. But a short at the 10-day line. Netflix is short at the 20-day line. Actually, I got to check here, make sure that, short at the 20-day line yesterday. I'm not sure why this is not updating. Let's try this again. There we go. Give it a second to update. I'm not sure what happened there. Anyways, that's basically the drill here. Let's see if I'll go back over some of these I was looking at. Microsoft short at the 10 again today. Where's AMD at? I think that was a short at the 50 yesterday and today, this morning. So there you go. Let's see now. Yeah, this is still downloading. Nova Gold, there's the big move higher. So the 4th day up, it was actually last Friday that you had the undercut and rally, and pushing up past the 11 level as I speak. So that one looks pretty good. It's acting very well, and has been one I favor. But they already reported earnings, so let's see if this guy's done. Still going. All right, there we go. Now let's see if all this comes up properly. and NVIDIA hanging in there. Oracle was a short at the 20-day yesterday, and then again today. Tesla, a short along the 20-day and near the 50, but didn't quite make it. So let's go back up now that I've got good data. Netflix short at the 20, going lower today. So you see what's happening. A lot of these are just breaking down. Meta was a short near the 200-day line on Monday, and now it's breaking below the 20-day line. Intel holding the 20-day line. So, I mean, technically, if it holds it, that would be a pocket pivot. We'll see if that holds. Otherwise, if it breaks, it's a short. Cisco comes out with earnings after the close, and Booking just getting clobbered. Apple hanging in there pretty well. It's kind of a surprise, but that's what 10% earnings growth will get you. Amazon, on the other hand, was a shortable gap down, and you can see that the highs, you use the high of the shortable gap down days price range as a short entry level, and it's been offering shorts 2 days in a row, and now today it breaks to the downside. So, nothing really there that looks all that hot. If we look at big stock clouds, these have been getting brutalized. And you got AppLovin playing out as a short at the 10-day line today. Autodesk, same thing. Bill Holdings had a big move, I think, after earnings. I'll have to double check that, but a short at the 50 today. You see Cloudflare, I think, was up on earnings, and that's reversing at the 200-day as short. CrowdStrike is short at the 10-day line. Datadog is short near the 50-day line, and just down the line. So you get a sense of what's happening here. So what are you doing? Are you talking about GDP data and blah, 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 and the jobs number? No, you're watching the charts, and the charts are telling you everything you need to know, and that is short the freaking rally. And so far it's working. It's still very volatile, though, because now what? The Nasdaq is up. It's down 50, NDX up 21. And just very choppy in here. But there are a lot of believers, and the media doesn't tell anybody anything. They just talk about the great jobs number and the Trump miracle, economic miracle. But I would ask a simple question: if the economy is so great, why is it that Trump has gotten all-time lows in polls regarding his handling of the economy? Because real people living in the real world, having to pay for real things, are just not making it. And so I think you can fudge inflation all you want. Look at 10,000 different data items and say this and that contributes to lower inflation, like computing power per dollar, et cetera, blah blah blah. But I've often wondered, why don't they just use a very practical measure of inflation? Because what's the whole point of measuring inflation? How much is it hampering the consumer? So higher prices among things that consumers actually buy on a daily basis, to me, is far more relevant than 10,000 data points that show inflation is 1.2%. Woohoo! That doesn't do you any good when you're going to the store. So that's my take on all that. But again, all I have to do is look at the charts, and these clouds are just death and have been death for a while. Look at Shopify. I think it was up this morning on earnings, a short at the 200-day line. Boom. So that's not very, very user-friendly. I mean, all of these charts, they just look like crap. Financials are interesting. I hear there is a big bank that's about to go under because all these real estate loans are now, that they've been able to market, all of them are now coming home to roost one way or another. And so you're starting to see some pressure in the financials. BlackRock coming apart, Bitcoin, which is now a creature of the financial world, the financial establishment, making another pushing down to the downside, down $2,700, 66,145. I had to laugh because Michael Saylor, I guess Strategy, reported earnings, and he's up there babbling about, oh, we have the Bitcoin president, but they went and bought more. I think like a 1.2 billion more Bitcoin in the first week of February at an average cost of just over 78,000. I mean, he should have just shorted it. I mean, the guy's an idiot. I don't care what anybody says. He's an idiot. He doesn't know how to trade. He made a good initial buy and maybe a couple after that. But really, I mean, and he's saying that Bitcoin will outperform the S&P by 2 to 3 times. Really? When? Right now, it's underperforming by probably more than that. So I think, in general, it's a function of what's going on in the financial world, which is co-opted crypto, unfortunately. And so you have Morgan Stanley is short at the 50-day line, Wells Fargo short at the 50-day line, JP Morgan probably going to be a short at the 50-day line. Getting down to the semiconductors. So there's AMD looking like a short at the 50. We'll see how that plays out. Analog devices have been a champ, still going higher. AMAT reports tomorrow. ARM Holdings, just kind of drifting higher, been beaten down. Astera Labs, I believe they reported earnings, and that's what happened to them today. So they gapped below the 50-day line. That was a short. Broadcom looks like a short at the 50. Intel again, KLA, trying to get above the 20-day line. I don't think I'd buy it. Same thing with Lam Research. They're probably waiting to see what AMAT does tomorrow. Microchip Technology moving higher. Micron, maybe it's going to peter out here along the 400 level. So, running into 10-day moving average resistance. NVIDIA back up to the highs, like I said. It does report earnings at the end of February. So we'll see where it goes from there. NXP has been doing well, back up near the highs. Question is, does that become a short sale entry zone? I don't know. Rambus, a short at the 20-day line. SanDisk has been a champ, but kind of wavering along the 700 level and the 10-day line. Seagate, wavering along the 10 and the 20. So you get the idea. This is not a rip-roaring bull market any more than we're sitting in a rip-roaring economy that is just going to grow like mad. I know Trump was babbling the other day about 15% economic growth. And the only time that ever happened, I think, was coming off the rebound from 2020, which, of course, as you know, was mainly a function of coming down, off of such a deep, deep level. So that's what I'm seeing. I just showed you a whole bunch of short sale ideas if you want to come in and do that. Obviously, the way I operate is very simple. I go after some of these inverse ETFs. So we had an early long entry signal in the Tech S, for example. I went long there around 1680. And you get a sharp run up, and I'm just sitting because I'm in good, and I'm just sitting with it, and it's hanging out. So we'll see how that goes as the day progresses. If we look at, let's see if I leave my pen there and see what happens. SOXS is a little less robust. I've gone after the Tech S primarily because the softwares are weak and the semiconductors seem to be persistent. Maybe tomorrow after AMAT reports, something will change there, but that's been my vehicle of choice. Meanwhile, if you're trying to play, the S&P, inverse S&P ETFs, they're working today. So you see how this pretty much follows the outline of the Tech S. What else? There's also the FAZ to consider because that is, financials. And of course, that had a nice signal early in the day right here. And then the moving averages cross right here. And now we're running up, coming in now, starting to pull back, which is normal. So we'll see how this plays out. But that's the way I'm dealing with it. I'm short. We'll see if that lasts for very long. But it's a fairly classic oversold rally. And, this is how I handle the short side. I don't operate on an anecdotal basis because, if someone tells me not to get piggy, well, that's a meaningless statement to me. What is meaningful is when you get down in here, okay, and this was last week, and this is where I covered my shorts. Come on, Black Pen, where are you? Here we go. You cover here. When the index is undercut and rally, it goes through this low, the mid-December low cover, and now you're looking at coming back in on the short side up here. And of course, this coincides, with stocks like AMD running up into resistance at the 50-day line and others, like I was showing you, Oracle. So you can see how the two kind of work hand in hand. But that's how you handle the short side, okay? When you get something like this, you cover. And then you wait for the rally, and then you come back in on the short side, if that's possible, and if it actually the market does show you signs of reversing near moving average resistance, as the market has today, after a big upside move. I think we were up over 200, something like that, on the Nasdaq, something like that. Anyways, so now you see what's happening. I gave you a bunch of short ideas you can check out on your own, or look to work the inverse ETF. So that's all I got. Got anything else, Chris?
Yeah, just to mention that that I think we know, but I looked at the stats on the Western countries. So if you look at the US, UK, and EU, the majority, that means more than 50%, and sometimes as high as 2/3, are financially pretty strapped. And that would explain also why you have a lot of social unrest, and approval ratings should not be high because, well, you got the majority of people that are struggling. And the doctored government statistics, nevertheless, the markets follow those, but we know they're doctored. Things like the CPI, from the BLS, we know that they've removed things that would hurt their case, and things like housing, energy, food, healthcare, and education, the things that matter. Those things are regulatorily captured, so they undergo the most inflation. But the CPI downplays those. Meanwhile, the things that are tradable goods, the tech and all of that, that's undergoing massive deflation because it's supply side. So when you weigh everything in, that's how you get the truflation numbers. But it doesn't reflect the ongoing struggle of, I think, the majority of people in Western countries. I haven't looked at Eastern countries, but Western was very telling. So with all that said, just follow the charts, because that's really where you get the real-time data. And as far as, the longer-term view, because some of our listeners and members have a longer-term approach, obviously you can marry some of these stats and follow along and get a sense. But ultimately, the price volume action of the major indices and leaders will tell you what the market is telegraphing. I mean, those are the most important metrics.
All right, that's it for now. Thanks for showing up, everyone. Good luck trading today, and we'll catch you next week. Take care.
So long, everyone.